Michelle Koppel. I'm an enrolled agent. I've been working on the ERC for the last 2 years. We've got over $1 million in refunds for our clients, and I'm here to answer some of your questions on the employee retention tax credit. There have been a lot of questions on the recovery startup business, so let's just get right into it. And let me show you what the IRS has to say. So here is the IRS Bulletin 2021-49, and you can look this up yourself. The bulletins that are put out by the IRS are used as law. So these are very reliable to look at. So this is the recovery startup business, essentially a recovery startup business that qualifies to get the employee retention tax credit. Is a business that started after February 15th, 2020. The only things that they have to do to qualify to get the employee retention tax credit is to be a recovery startup business, having started February 15th, 2020, and had employees and made under $1 million in average gross receipts over the last 3 years. So these people automatically will qualify for third and fourth quarter. Now, some of the questions I got about this was someone said, I paid employees, but I didn't file Form 941. Can I still get the employee retention tax credit? The answer is no, because if you paid somebody as an outside contractor, that is not an employee for the purposes of the employee retention tax credit. So you may have paid money to someone, but if you didn't withhold taxes and you didn't file a Form 941 and a W-2 for those people, they are not employees for the purposes of the employee retention tax credit, and you will not qualify. It has to be wages. So the other question that I had is, how do we file? Is it filed differently than the other forms when you file for getting the employee retention tax credit? So let's go right over and look at Form 941X. This is the form that we file for the employee retention tax credit. Now, whenever there's an X on a form, it means it's an amended form. So there was an original 941. That's the assumption. You can't file an amended form if there wasn't an original. So this is an amendment to your 941, and this is where you claim the credit. Now, if you are a recovery startup business, box 31B, this is the only difference on how you're filling this out. Check here if you are eligible for the employee retention credit in the third or fourth quarter of 2021 solely because your business is a recovery startup business. Check. There you have it. That's really the only difference in terms of filing the form. So the other question that I get is, what if I was a recovery startup business? Can I only qualify for third and fourth quarter 2021 for the employee retention tax credit? It's a great question. You can qualify for all the quarters from the time that you started your business. And let's talk a little bit more about that, since the IRS said a recovery startup business starts after February the 15th, 2020. That's not a hard and fast rule, because we have to always look into how the IRS defines everything. So starting a business, according to the IRS, is not when you incorporated, became an LLC, and so forth. It is when you had services or products available for sale, and it's very specific. So let's say you incorporated at the end of 2019, and you built out a building, and now you opened up your office, but the office wasn't opened until February the 15th or 16th. Then you are offering services and or retail. That's a recovery startup business still, even though you incorporated prior to that date. Anything after the date of February 15th, 2020 is going to qualify as a recovery startup business as long as those gross receipts are not high. So the other question that I have about this is, how do you qualify if you're a recovery startup business and you're going to qualify for quarters other than third and fourth quarter of 2021? Can I qualify, and how do I qualify? Yes, you can qualify on all of the other quarters that the employee retention tax credit is available. You can qualify by partial suspension, and you can qualify by reduction in gross receipts. Now, this is a little business the full amount of time. Now, remember, when we're qualifying by gross receipts, we are qualifying you 2019 as the base year. So in 2019 is the base year. So it would go quarter by quarter. So first quarter 2019 compared to first quarter 2020, there must be a 50% drop in gross receipts. Second quarter 2019 compared to second quarter 2020, 50% drop in gross receipts. Third quarter 2019 compared to third quarter 2020, 50% drop in gross receipts, and so on for 2020. In 2021, we still use each quarter in 2019 as the base year for comparison. The difference is it only has to be a 20% drop. So again, it's first quarter 2021 compared to first quarter 2019. If there is a 20% drop in gross receipts, then you qualify, and so forth. Now, problem is with a recovery startup business, let's say you started third quarter of 2020. So you do not have the base quarters in 2019 to compare so that you can show that you had a reduction in gross receipts. Well, now the Bulletin 2021-49 addresses that issue. Looking for page 33. All right, let's share this again. That's the same bulletin. We're on page 33. And so they've been asked, how do you calculate gross receipts of employers that came into the existence in the middle of a calendar quarter in 2020? So you do not have 2019 as a base quarter to compare to show that you had a reduction in gross receipts. So what we might call an alternative quarter. So if you had a full quarter in 2020, let's say third quarter 2020, you have gross receipts. Now you can use that third quarter in 2020, that's your first quarter. You can compare it to fourth quarter 2020. If you had a 50% drop, that's a qualifier for a reduction in gross receipts. Again, you use third quarter of 2020 and compare it to first quarter 2021. Is there a 20% drop in gross receipts? And then you can still use third quarter 2020, compare it to second quarter 2021. Was there a reduction in gross receipts of 20%? If there was, then you qualify by gross receipts reduction. Now, in third quarter, if you still had a 20% reduction in gross receipts compared to third quarter now 2020, you're gonna qualify by gross receipts. And you could qualify as a recovery startup business. So I would pick the one that would get me the most money. So a recovery startup business is limited to a $50,000 per quarter refund. So if you had 10 employees who each made $10,000 each, you could potentially have $70,000 in refunds for third quarter if you qualified by the gross receipts as a recovery startup. So it's important that you kind of compare and see which way am I going to get the most money back. So so alternative quarters, looking at page 33 of IRS Bulletin 2021-49. So now, is the ERC taxable? This is the next question that I get. Is it taxable refund? From the federal level, it is taxable. Again, this is laid out in these bulletins. It's very specific how it has to be handled. Even if you are cash basis, you must go back and amend the years. And what you have to do is, if you had the employee retention tax credit that you got for wages paid in 2020, you need to go back to the 2020 tax return and you deduct out the ERC from wages. You don't put this as other income. You don't put it as ERC income. You put it as a credit against wages. So if you had wages of $100,000 and you had the employee retention tax credit of $50,000, now you go back and amend, and you subtract the $50,000 of ERC, and now your wages become $50,000, which shows an increase in income of $50,000. So even if you're cash based, you have to do this. This is the instructions from the IRS. 2021 will have to be amended if you get the ERC for 2021. Same thing. Now, most people are getting interest income along with their checks. That interest income I would just put in the current year, the year that you got the money. It's not required that you go back and apply that to the previous years, because that interest has been accrued since the time that that you paid your payroll taxes for that quarter. So it is taxable on the federal level. That's very clear. Now, a lot of times the states differ from the federal laws. And in this case, there's only a few states that differ from the federal law. California is one of them. California does not tax the ERC. So if you're going back to amend your tax return because you got the employee retention tax credit refund, then you do not have to amend California. California differed from the federal government in the PPP, where PPP was not taxable federally, it was taxable in California. So you need to check your state to see if it's taxable. You may only need to amend your federal return. Most states are taxing it, but just a heads up. Now, the other question I got is, what if you're a PEO? So a PEO, what is a PEO? That's Professional Employer Organization. So there are a number of people I've worked with who they are PEO. So let's just look at this here. Professional Employer Organization. So what happens when you're a PEO? It's that somebody else is filing your payroll. It's technically filed on their EIN. So you do not have a 941. So how do you amend it to get the ERC? You cannot amend a 941 if you didn't file it, and you can't go amend it on behalf of someone else who has, I can't go in and amend someone else's return for them who I am not authorized to amend. So what happens in that case? There are a lot of companies that are PEOs. We have Insperity, we have TriNet. ADP has a whole section that is a PEO. Most of ADP is not PEO. If you have a 941, then you're not a PEO. But if your employees are paid by a PEO, then you have to work with them. Now, we've done a number of these where what happens is they must file the amended 941 under their EIN because it was originally filed under their EIN. So the 941X goes on their EIN and you have to work with them. I've done this with a number of companies. We do all of the calculations. We do all the qualifying, which is really important. Requiring is that you attest that you qualify, which it's really your responsibility to make sure that you qualify for the ERC. Otherwise, when those audits come around, that is going to be ready to go. So make sure that you qualify, but you must work with the PEO. They will have special spreadsheets, special documents that they want you to fill out, and then they will, in aggregate, with all of the other companies that they are the PEO for, they will be filing the 941X. So these have been slower than molasses to be done. I don't think I know one PEO has actually filed the forms with the IRS. So we are working with them, but they've got thousands of clients and they've got to put them all together. They've got to file it with the IRS. Then the IRS has to refund the PEO. It does not go directly to you. It goes to the PEO company, and then they in turn pay it to you. So you can do it. We're doing it. It's going to take longer than it normally takes with everyone else. Now, some other points that I want to cover. Really important that you check your eligibility dates if you are qualified by a partial suspension. So many people are just thinking, well, this went into law March 13th. I'm starting there. No, check your state. California, the shutdown was March 19th, 2020. Every state, there's different rules, there's different laws. I have a whole video on that if you want to know how I qualify people for partial suspension. It's important that you do this now because those laws are disappearing off the internet and you need to have them. You have to have them in order to figure out which dates you qualify for. You can't just take all of March. You can only take the dates that you qualify. And there's one state also where there's only a qualification. They are only qualified for 2 months. So some states, they just didn't have many regulations. And so the partial suspension qualifier is very, very limited for those people. So please check the dates and check the laws. Now, be really, really careful. I can't emphasize this enough. So many people who are wanting to actually do this program for people and they're not doing the proper qualifications. They're running through it and just letting you decide if you qualify. You can't just say, well, I was partially suspended. My business was impacted by COVID. No, the laws don't say that. That's not how you qualify. So you need to make sure you are qualified by the laws and that you had a partial suspension that affected you more than 10%. And the IRS did not define 10% as dollars, but 10% in suspension. This could be occupancy, this could be limitation in your space, all kinds of things could be giving you a partial suspension. Now, the other thing, I have to remind everyone, there are many wages that are not eligible for ERC, and so there must be a very defined calculation. What doesn't qualify? Contractor pay, that means 1099 people, that does not qualify. R&D credit wages do not qualify. So we have people who have R&D, and usually that's research and development, they get special credit. So you can't double dip. That's the basic rule. So we'll go through and we'll take out any wages that were used for the R&D credit, and then the other wages are available. You can use those for ERC, but just take out the wages that are R&D credit. You can't do it for both programs. So the FFCRA, this is another thing that came up where I was talking to one of these payroll providers, service providers, and I said, I need to know the COVID sick leave and the COVID family leave. Please make sure that the documents have that in it. And they're like, no one's asked for that. Because nobody knows what they're doing out there. So no, those wages, you already got a refund from the IRS for any COVID sick leave. If you applied for that, I believe it's line 11A or B on the 941, you can see that it's right there. So you have to deduct those wages. They don't qualify for the employee retention tax credit. Sick leave and vacation pay that was accrued prior to eligibility dates, those do not qualify. They've got to be deducted out. It can get really tedious. So essentially, if there's some sick or vacation pay, some kind of PTO that is in the first few months of qualifying, and they qualify for maybe a year and a half, but the first few months, I just deduct out the sick leave and the vacation pay just to be careful that a lot of the owners don't know when they were accrued, so it's just better to not put them in. So PPP, any wages used for PPP cannot be used for the ERC. Again, it's double dipping. So I look at Form 3508, which is the application for forgiveness for the PPP. This says how much of that PPP you used for payroll costs. If you did 60-40, you were allowed to do 40% other eligible expenses. Then we don't have to put as many wages into PPP forgiveness and subtract them out. So it's important that you look at those things, look at the dates, and what defines wages for PPP. It's different than what defines wages for ERC. ERC are wages earned by the covered date. PPP are wages earned or paid in a certain time period. So all of these little things have to be figured out. I want to touch on one more little thing before I close, and that is what are owner wages. At first, this was a gray area. No one could agree. And the IRS came out and they defined it here. Essentially, if you have a husband and wife who are shareholders, well, basically anybody over 50% owner, those are owner wages. They don't qualify for ERC. But the way the IRS defines this is husband and wife are like one. So if you got a 50-50 split, then they're 100% shareholder, and both husband and wife do not qualify. If three brothers together own a company and they each have 33 1/3%, those wages don't qualify. You're considered 100% shareholder. All of these relationships come into if you're an owner or not, and which wages do or do not qualify. Child or descendant of a child of a majority shareholder, and that would be in like the three brothers owning 33%. Each of them, their child or descendant of the child, their wages don't qualify. So if you have family that are on your payroll, you need to look through these rules. This is page 26 of this bulletin 2021-49, and it goes on and on. So just be sure that you understand which wages qualify and don't, so that you can sleep at night knowing that the IRS isn't going to come back and audit you and say, wait, half these wages that you applied for don't qualify. You don't want to be in that position later on down the line. So do it right to start with, and keep the questions coming. And I'm happy to answer any questions that you have on the employee retention tax credit. Just email me, Michelle Koppel at ea@gmail.com. That's MICHELLEPPEL, stands for enrolled agent, @gmail.com. And I'll try to answer everything that I can. Thank you so much.